So it seems like this bank in Canada, this mortgage lender in Canada, just can't get a break. Zero Hedge is all over this like flies on stink. We got another problem stemming from this. This is 3 days in a row, something from the original mortgage lender turning into something worse, First, I said, if there's any pension fund attached to this turd, good night, I'm sorry. Then it came out the next day that another company is going to bail out, give it a huge loan with huge interest on it. We didn't know who it was. Then, the next day it comes out, oh, it's another company that this guy who also sits on the board of both companies, and there's 321,000 pensioners that just got this turd added to their little package, their pension. Here's a new investment for you guys. Walking Dead Man. Here, toxic asset. That'll do you real good. So, Zero Hedge has a new article the next day. Panic bank run leaves Canada's largest alternative mortgage lender on the edge of collapse. What? After 2 years of recurring warnings, both on this website, Zero Hedge, and elsewhere, that Canada's largest alternative, as in non-bank, mortgage lender, is fundamentally insolvent. Kept alive only courtesy of the Canadian housing bubble, which until last week had managed to lift all boats, Home Capital Group, or HCG, suffered a spectacular implosion last week when its stock price crashed by the most on record after HCG revealed that it had taken out an emergency $2 billion line of credit from an unnamed counterparty with an effective rate as high as up to 22.5%, indicative of a business model on the verge of collapse. Or as we put it at Zero Hedge, Canada just experienced its very own new century, remember that one? Moment. 1 day later, it emerged that the lender behind HCG's pre-petition rescue loan was none other than the Healthcare of Ontario Pension Plan, or HOOP. As Bloomberg reported, the Toronto-based pension plan, which represented more than 321,000 healthcare workers in Ontario, gave the struggling Canadian mortgage lender the loan to shore up liquidity as it faces a run on deposits amid a probe by the provincial securities regulator. Home Capital has also retained RBC Capital Markets and BMO Capital Markets to advise on strategic options after it secured the loan. Why did HOOP put itself, or rather its constituents, the pensioners, in the precarious position of funding what is a very rapidly melting ice cube? The answer to that emerged when we learned that HOOP President and CEO Jim Keohane also sits on Home Capital's board and is also a shareholder. But how did the regulators allow such a glaring conflict of interest? According to the Canadian press, Keohane had been a director of Home Capital until Thursday, but said he stepped away from the boardroom on Tuesday to remove the conflict of interest when it became clear HOOP might step in as a lender. Keohane further clarified on Friday that he doesn't view the Home Capital investment as risky because the pension plan will be provided with $2 worth of mortgages, or I think he meant $2 billion, worth of mortgages as collateral for every... Okay. Because the pension plan will be provided with $2 worth of mortgages as collateral for every $1 it lends to Home Capital. Quote, we take comfort from the underlying asset portfolio, so we are not looking at Home Capital as a credit, he said in an interview with Business News Network Television. He added that a correction in the housing market is not of great concern, since the values of homes would need to plummet by more than 65% for the fund to make no return beyond the value of its principal commitment. Furthermore, it appears that Canada's pensioners are priming all other company lenders. Keohane also said that the funding syndicate would rank above Home Capital's other lenders. Quote, we have security interest in the collateral we've received, so we have the right to sell that collateral if we don't get paid. And then the balance that's left over would go to recovery for other creditors. End quote. The implications is that as long as HCG's mortgages don't suffer greater than 50% losses, HOOP's pensioners should be money good. Of course, if this is indeed Canada's subprime moment, any outcome is possible. And did we see 50% drops in mortgage prices after the 2007-8 meltdown? What were the all-time lows? 2011, 2012? Ooh, the fire sale deals. Houses in my neighborhood going for over $300,000. Purchased for $120,000, $130,000 at the low. That's a bigger than 50% drop. As for other lenders or the pre-petition, because there will be a petition here, the only question is when and in what form. Equity. That's some $4 billion in assets that was just stripped from existing collateral. The best price may come from breaking up the company. In any case, the company's frenzied emergency measures to stabilize the near-insolvent mortgage lender were not nearly enough, and despite HCG stock posting a modest rebound on Friday between hopes of a rumored sale and a short squeeze, those hopes may be dashed soon because, as the Globe and Mail reports, the depositor bank run that gripped Home Capital Group in the past week only got worse after the company revealed just how precarious its funding situation had become. First, any hope of the company, or rather its investors, may have held of a sale appeared dashed. Investment banking sources cited by the G&M said the best possible price may come from breaking up the company and selling portions of its mortgage portfolio to regional financial institutions, which also implies that aside from a few select assets, there is no equity value left. Or in other words, any potential buyer is now motivated to wait until HCG liquidates and then picks off the various assets in bankruptcy court. There are structural limitations as well. Home Capital currently holds $18 billion in home loans outstanding, a portfolio that would be difficult to swallow for rivals in the alternative mortgage sector, such as credit unions, small mortgage lenders, Montreal-based Laurentian Bank, and Edmonton-based Canadian Western Bank. These institutions, along with private equity firms, could still bid for pieces of Home Capital, the G&M admits. The only question is why then would do so why they would do so before a bankruptcy filing, right? Why are you going to do this now when you could wait for the bankruptcy filing and then pick it up for pennies on the dollar? While one prominent name features on the list of potential buyers, that of PE giant J.C. Flowers, whose CEO, J. Christopher Flowers, earlier this year said he expected to expand the company's Canadian real estate lending business. Canada's 6 banks are notable for their absence on a list of bidders. The reason is that Home Capital lends money to home buyers who have been turned down by the major banks, and none of these institutions is expected to enter the alternative mortgage sector by acquiring the company. So they don't even want the customers that this company wants in the first place, which means how many of these mortgages are really super subprime. National Bank of Canada proactively called the equity analysts who follow the company this week to say it would not bid on Home Capital after being asked if it was a potential buyer. Needless to say, the big banks would be quite delighted if one of their bottom-picking competitors would suddenly go bankrupt. When you have a bank run, people get spooked, which brings us to the most imminent risk facing Home Capital Group and its subsidiary Home Trust. Recall that on Thursday we observed that as concerns about HCG's viability mounted, depositors were quietly pulling their funding from savings accounts at subsidiary Home Trust. By Wednesday, when Home Capital revealed it was seeking a $2 billion loan to backstop its sinking savings deposits, shareholders ran for the exits, driving down the company's share price by 65% on Wednesday alone, and heightening the sense of panic. On Friday, the company revealed that high-interest savings account balances fell another 36% to $521 million by Friday morning, down a whopping $293 million from $814 million just Thursday, and more than $2 billion a month ago. In other words, had it not been for the emergency HOOP loan, the company would likely be insolvent as of this moment, following what may be the biggest bank run in recent Canadian history, which also explains why the interest rate on the loan was above 20%. When you have a run on the bank, people get spooked and they sell and ask questions later, said a Bay Street investment banker. It's investor psychology that takes over. As is usually the case, regulators appeared on the scene just one day too late, right? A day late and a dollar short, or a dollar short and a day late, however you want to say it. Canada's banking industry regulator, the Office of the Superintendent of Financial Institutions, has gathered data from other financial institutions this week, both to monitor for signs of a broader depositor panic and to track down where funds are moving as they leave Home Trust. Again, a day late and a dollar short. The regulators come in. And this same regulator, OSFI, sent an urgent request Wednesday to several smaller and mid-sized financial institutions and credit unions to provide the regulatory with up-to-date information about their savings accounts, according to a source. So not only did this cause some concern, we're going to just go across the board, sweeping thing here, and ask all the smaller people, companies, banks, institutions, how are you guys looking? How's you guys having a bank run? Is there any issues with the saving? Why? It's just, this is a non-banking entity. It's just a mortgage entity. What's going on? Why are you concerned? Specifically, OSFI wanted to know the institution's most recent account totals for high-interest savings accounts, as well as data on recent redemptions and current levels of high-quality liquid assets. The request, which the OFSI said had to be fulfilled as soon as institutions are able to, is seen as an attempt to take the pulse of the market by tracking where deposits flowing out of home capital may be going and to gauge whether there is any contagion among other institutions. Right, that's where it's really at. Not where they're taking the money and putting it. It's, are other institutions seeing the same thing? That's the key here. In recent days, some smaller and mid-sized institutions have also struck up early-stage discussions about whether multiple institutions could join together to explore a deal to buy some of Home Capital's assets. As for Canada's big banks, they have already decided that HCG won't survive. Several months ago, Canaccord Genuity Group, Inc. told its financial advisors they could no longer steer investors to high-interest savings accounts at Home Capital or rival alternative mortgage lender Equitable Bank. Client money already placed with either bank had to be moved within 60 days. So that means they are taking the money out of these other institutions. Then, after Home Capital revealed in March it was under investigation by the Ontario Securities Commission, that's a different group, over its disclosure practices, Canadian Imperial Bank of Commerce introduced a cap of $100,000 per client for purchases of Home Capital Guaranteed Investment Certificates, which is the maximum level covered by Canada's deposit insurer. A spokesperson from Royal Bank of Canada said that several weeks ago the bank introduced a $100,000 cap on Home Capital GICs bought through a full-service broker, although there were no limits for purchases through the firm's discount brokerage. On Thursday, RBC also released the following entertaining price target scenario. It still has a price target of $8, but fear not, even if RBC is wrong, it promises at least $4 a share in residual value. We are not quite as optimistic. Additionally, last week, Bank of Nova Scotia said it would stop selling all GICs sold by Home Trust, but said Monday that policy was amended to a limit of $100,000. Bank of Montreal's brokerage unit also confirmed it has a $100,000 limit on Home Trust GICs, but would not say when it went into force. That's because it was happening immediately. As G&M adds, the OSC news shook investors, but the panic was heightened as news of the bank's moves to cap investor deposits slowly seeped through Bay Street in subsequent days, raising concerns that major financial institutions were pulling away from Home Capital. We are out of the position. When asked if Home Capital could survive this run on its deposit, Keohane, formerly at Hoop and the company's last remaining source of funding, said it was possible. I think it's a viable business, he said. Their cost of funding is going to go up, which may impact earnings. It's always a possibility that some other institution may have an interest in taking the entity over. If you can have access to a lower funding cost, it's quite an attractive purchase, he said. Most disagree, and if it is safe to assume that the depositor run won't stop until every last dollar held at HCC has been withdrawn. Meanwhile, late on Friday, Home Capital's second biggest shareholder, Calgary-based QV Investors, disclosed that it liquidated its position, selling 8.4 million shares. That's a lot to dump. QV Investors previously held a 12.8% stake in Home Capital, Toronto-based Turtle Creek Asset Management is Home Capital's biggest shareholder with 13.6% stake. On Saturday, another prominent investor bailed when Calgary-based Mauer Investment Management sold 2.75 million shares of the alternative lender. CIO Jim Hall told Bloomberg in a phone interview, "We are out of the position," Hall said. Mauer also has reduced holdings in Canadian alternative lender Equitable Group. All these investors will now be forced to explain to their LPs how they missed a ticking time bomb with so many, this website at Zero Hedge here included, had warned about for over a year. How'd you guys miss it? How did you effing experts, the ones managing billions and hundreds of millions, we have 18 billion under management. How the hell did you miss this, you freaking experts? In me, Jason 4 reading Zero Hedge to you, Zero Hedge caught it a year ago, raised an alarm, raised a flag. Anyone willing to listen? Here's 2 flags. This is going to be a problem in the future, it looks like. Nope, no problem here. No one cares. And now the damn stock was down in one day 65%. How many people took a hit on that? God knows how many. Home without the Capital Group. As for Home Capital Group, or more aptly, Home without the Capital Group, the future is bleak, and a bankruptcy liquidation appears the most likely outcome. What impact such an event will have on the broader Canadian housing market remains to be seen. Last week, shortly after HCG's rescue loan announcement stunned the otherwise asleep Toronto tape, the Canadian housing regulator warned of strong evidence of housing market problems. Looking back in a few months, that may prove to be a vast understatement. And the article they link to is another one of their own from Zero Hedge. Canada housing regulator warns of strong evidence of housing market problems. Zero Hedge posted this on April 26th, by the way. And it was short, but might as well get into it right now. In a peculiar coincidence, just after Home Capital Group imploded in what we dubbed Canada's new century moment, Canada's housing regulator, the Canada Mortgage and Housing Corporation, which describes itself as contributing to the stability of the housing market and financial system, moments ago said CMHC issued a report warning that there is, quote, strong evidence of overall problematic conditions, end quote. What? Market's on fire. I was just telling you, what, a month and a half, they're having the bozo shows over in Canada. Come on in. The house flipping bozos. Come on in. And the guy said, I decided to fork over $150 to get into the stupid thing, and I got a discount. He said I got it for like half price or whatever, just to see if this is real. Is anybody showing up? And the place was packed. And people were excited to get into this and get into house flipping again. Oh, this is going to be great. And I said, it's people out of their freaking minds. The market's at an all-time high. And now all of you are going to compete with yourself to buy and flip these houses. You guys are idiots. You're freaking morons. In the report, the housing regulator again warns that while conditions in Canada's housing markets are showing some signs of improvement, the overall rating from the Canada Mortgage and Housing Corporation will be held at strong evidence of problematic conditions. As noted in the press release, some of the reported highlights are the following. Overall rated to be at strong evidence of problematic conditions. Also, evidence of overvaluation at the national level has been downgraded from strong to moderate. It is now present in 6 centers instead of 8. Evidence of overvaluation has increased from moderate to strong in Victoria as fundamentals are not keeping up with higher prices. There is also moderate evidence of price acceleration and overheating, leading to strong overall evidence of problematic conditions. Also, conditions have improved in Regina, Montreal, and Quebec relative to home prices. Overbuilding has gone down from 8 centers to 6. In Moncton and St. John's, the supply of homes is adjusting to the demand. Vancouver's housing market continues to show strong evidence of problematic conditions due to moderate evidence of price acceleration and strong evidence of overvaluation. Anyways, CMHC defines problematic conditions as imbalances in the housing market. Imbalances occur when overbuilding, overvaluation, overheating, and price acceleration, or combinations thereof, depart significantly from historical averages. Canada, I think we got a problem. In America, we're going to have the same problem too. Get ready for real estate collapse 2.0. It's coming. I've been telling you about it all year long. 4 months into the year, about to be 5 months. It's coming. There's always signs of it imploding. This is one of them. Take care.